Hello and welcome to the Tax Roundup for November. We're going to start off by looking at travel allowances and substantiation and some movement from the ATO on that front. We're looking at the early engagement program also from the ATO and when it's appropriate to use it. A quick look at the new controversial paid parental leave bill before Parliament before moving into cases. Now we've got two great cases. The first dealing with excess contributions, which continues on today, a series of court cases there, but also a GST and Property Development case, which really shows you how it can get really messy very quickly and why you need good advice. But first up, Brad from BMT Quantity Surveyors is going to take you through some things that you might not know for your property investment clients.
In the 2016 year, across all the depreciation schedules we prepared, the average deduction was just under $10,000. Now this is for residential properties, both new and old. Now in order to be comfortable in claiming that much deduction, because it's quite high, what we do is make sure that we thoroughly go through and assess everything in that property. We visit, we look at the items in there and make sure we find everything and then apply the correct rules so that your risk is covered along with the client.
Now across to Ray on those substantiation exemption and travel allowances.
Let's talk about substantiation and travel expenses. Now, as we know, when a taxpayer incurs an expense, they're required to keep not only evidence of that expense, but also the nexus with their assessable income. There are very limited exceptions to this, and one is the substantiation exemption when a taxpayer is travelling for work purposes or another deductible purpose, and they incur expenses in relation to that travel. This is under our self-assessment system, and this substantiation exemption has been around for over 30 years, but it is causing a lot of confusion still. There's been quite a few cases in the last couple of years where taxpayers thought they could claim certain things without the appropriate records under the substantiation exemption, and the tax office have disagreed. So the tax office have recognised it's actually quite a confusing area. The guidance thus far from the tax office has not been particularly clear. So in order to address those concerns and get some feedback from taxpayers and tax practitioners, they have released a discussion paper in relation to how this whole area can be made administratively more simpler. That discussion paper is available on the ATO website. There's a link in the tax roundup, and they will be accepting submissions until the 22nd of November. So if anybody's got some burning desires to discuss this, I suggest they contact the tax office.
Also from the ATO, Mike is going to take you through that early engagement program.
Now, over recent months, we've seen an expansion of the types of products that the ATO have been issuing to assist taxpayers interpreting tax law, basically. We've had law companion guidelines, PCGs as well. We've seen some tinkering with the ATO on the way ruling processes work and giving more options to taxpayers in the way they engage with the ATO. Another step in that direction is an expansion of the ATO's early engagement process to small businesses. This was something that was previously only available to large businesses, but is now being offered across the board to all business taxpayers. Basically what this involves is where a taxpayer has either just undertaken or is considering undertaking a transaction or being involved in something that is reasonably complex from a tax point of view. It's a way of engaging with the ATO and letting the ATO know that this either has just happened or that it is about to happen, and basically being proactive in the way of arranging for the ATO to be in touch with you and work through some of those issues as early as possible. There's a number of ways that you can basically kick the process off if that's the road you want to go down. You can basically request a call from the ATO. The ATO has suggested a 2-day turnaround for that, 2 working days. So you basically let them know that you're interested in the process. They have indicated they will contact you within 2 days, basically to talk about what the next steps would be and where do you go from here. The other way of engaging with the ATO through this process is there's actually an application form. Presumably you fill out some high-level details of the transaction or the thing that you're concerned about and send it off to the ATO so again the process can begin. Typically what you'd expect through that process is a bit more kind of ongoing dialogue with the ATO. Often there would be either a meeting or some phone calls with the ATO to flesh out kind of the key issues that might be relevant and try and work out a way forward to get to the bottom of those. You would expect in lots of cases that at the end of the process there'd probably be some sort of private ruling as well. Now that might cover the whole transaction. It might be just you've identified with the ATO a couple of key issues that really need to be covered off in that format. So it's worth being aware of, again, if you're advising small businesses, as well as the normal private rulings, the conversations you might have with the ATO in the ordinary course of the work you're doing. Just remember that this option is now available to smaller businesses as well. The sort of thing you'd probably reserve for where the numbers are big, where the issues are complex, where you're dealing with maybe with some new legislation where there's not much guidance. That's the sort of the issues, the areas that you might consider this type of approach with the ATO.
When did paid parental leave become so contentious? There's a bill before Parliament called the Fairer Paid Parental Leave Bill 2016. Now, I thought it'd be interesting with the amount of media it's generating just to take a closer look at that. Now, as you know, for eligible people, when you can claim up to 18 weeks of paid leave at the minimum wage from the government. Now, this is completely unaffected by anything you may receive from your employer. So if you get a part payment or a full wage when you're on leave, then you can still claim the government benefit on top of that. This is interesting because when you look at the OECD statistics on Australia, it shows that women on average get 42% of their previous wage while they're on parental leave, while they're on maternity leave. Now, 60% of that is made up by public sector employees who can claim up to 18 weeks leave at their full pay, plus also claim the parental leave allowance on top of that. And also for the corporate sector as well. If you're an income earner and your employer pays a very generous parental leave payment, then you can still claim the government payment. So what the bill is looking to do is change the system. So if you are receiving employer-sponsored payments already while you're on parental leave, then the government scheme will just be a top-up. If those payments do not meet minimum wage, then the government will top it up to minimum wage. But if you're already above that, then you won't be able to claim the allowance anymore. Now, the start date may be 1 January, it may be further down. It really depends what the Senate does, and I suspect they will change the start date of this legislation. But interestingly for employers, not only will it mean looking at potentially a change on how you package things like parental leave, but it also looks at how the system is administered and will remove the onus from employers to be involved in parental leave payments, but instead employers can opt in if they want to, but in general all payments would be administered by the government department. So it will free up a bit of that administration from employers if they choose not to be involved. But we'll let you know the progress of the bill as it goes through Parliament, one way or the other. Watch out for our Twitter feed. But now across to cases where Michael Carruthers is going to take you through that GST and property development case. Across to you, Mike.
We're looking this month at the FKYL and Commissioner case, which is an AAT decision that has been recently handed down. This deals with the GST implications of a property development project or a series of property development projects that a taxpayer undertook a number of years ago. Now, this case is a bit of a mess, to be honest. I mean, we're dealing with a taxpayer who didn't seek any legal advice, didn't seek any accounting advice, and basically the ATO were trying to help them figure out their tax calculations around this GST based project that they were looking at. What happened was we had a property developer who acquired a number of blocks of land. I think there were 4 blocks of land that were acquired. They built some residential dwellings on those blocks of land and then sold the dwellings off. But most of them, if not all of them, had been rented out for a period of time prior to sale. Now, while this case is a bit of a mess, what it does do is it highlights the range of issues that would often need to be dealt with when it comes to a property development project, when it comes to the GST issues. Now, in this case, the AAT started off by looking at, were these dwellings new residential premises? The AAT said these were brand new dwellings that have been built, so typically they would be treated as new residential premises. What the taxpayer argued was that they'd been owned for a period of time. The land had been owned for a significant period of time prior to these properties being sold. So this person was saying, well, there's a 5-year rule that should apply here to stop these properties being subject to GST on sale. Now, the AAT looked at that and looked at the facts and said, well, in some cases, these properties were sold within 5 years of construction being completed. There's no possible way you could argue that there was a residential dwelling there prior to construction actually being completed. So that knocked out that argument for a number of the properties. For the other properties where there had been a 5-year period since the dwellings had been completed, the AAT basically looked at what had happened during that period of time. In order for the 5-year rule to apply to ensure that a property is no longer treated as new residential premises, it needs to have been used solely for deriving input taxed residential rental income for at least a 5-year period, and that generally needs to be a continuous basis. And in this case, that just hadn't happened. There wasn't that 5-year sole rental use in this case. So the AAT kind of dismissed that argument and said that these were still new residential premises being sold. The next issue that was looked at was around the margin scheme. So the taxpayer said, well, if there is a GST liability on sale, I want to be able to use the margin scheme. Now, interestingly, in this case, the taxpayer had bought the properties under the margin scheme, and there was a bit of mucking around to see whether there was evidence of that or not. And when you buy property under the margin scheme, that normally means you can then sell it under the margin scheme. And if you've dealt with these rules before, you would know that rather than paying GST based on the full sale price, you're basically paying GST on the difference between the sale price and the purchase price for the property. Now, the key thing here was, though, that there was no evidence of a written agreement between the taxpayer and the purchasers of these properties saying that they agreed to use the margin scheme. And it is important that there is that agreement. The legislation says you can't use the margin scheme unless there is an agreement in place. The Commissioner has some discretion around when that happens in some cases. But in this case, the taxpayer just couldn't produce any written evidence. So the AAT just had to say, sorry, we see no basis for using the margin scheme. What that meant was that unfortunately the taxpayer then was assessed on basically GST on the full sale price. But it meant that because they had acquired the properties under the margin scheme, they couldn't claim back GST credits for purchasing the land in the first place. So they missed out on the GST credits when they bought the property, and it meant that they paid more GST when they sold. As I say, a real mess. The other issue that the AAT looked at, which again is quite an important one, a really common issue around property development, is this taxpayer had bought the land, built these new dwellings for sale. The evidence suggested that the plan was to sell these properties after they were completed. However, in each case, they were actually rented for a period of time. In some cases, the tenants had said, yeah, we want to buy it, we just can't afford it at the moment. So they had this arrangement where they would rent for a period of time until they could save up enough money to buy the properties. Now, why that's relevant is because it comes back to the issue of what GST credits could be claimed on things like the construction costs for those dwellings. The AAT had kind of tried to help the taxpayer figure out what the calculation should be, and the AAT basically confirmed the Commissioner's approach. So in this case, what happened was the AAT said, well, these properties have been sold as a taxable supply, as a supply of new residential premises, but at some point in time they have been used for input tax purposes. They've been used to derive residential rental income. Because of that, you can't claim all the GST credits on the construction costs. You need to apportion that. And the AAT accepted an output-based method, basically. So the portion that was claimable was basically the sale price over sale price plus the rent that had been derived from those properties across the relevant period of time. So while a large portion of the GST credits were available, it wasn't the full amount. It was a portion that was denied GST credit. So a whole range of issues that were covered in this case. As I say, a bit of a mess, but it does provide a nice summary of some of the big issues that property developers need to be on top of, and advisors to property developers need to be keeping track of across the life of the project. In this case as well, the Commissioner had originally assessed a 50% penalty on this taxpayer on top of the GST liability. The Commissioner then reduced that to 25%. The AAT figured that was reasonable given these circumstances. This person had not gone and got any advice. They really hadn't got the assistance that they should have. This was complex issues they were dealing with. They really should have taken more care than what they did in completing their activity statement. So the AAT felt 25% was reasonable because they had not taken reasonable care in basically the way they'd prepare the GST returns.
Now across to Ray, who's going to take you through that case on excess contributions.
Does anybody remember the bad old days of excess contributions tax? Where a small amount of contributions over a non-concessional contribution limit could result in a very hefty tax bill. Now, although fortunately we don't have to face those rules anymore, they were in place for a while and we're still seeing the effect of that. In the case of Ward, the taxpayer had made contributions to a superannuation fund in the 2009 tax year. Subsequently, he retired, he pulled the money out of superannuation and he put it into term deposits. The GFC hit, not a good time for anybody. Then, in the 2011 year, the taxpayer made the contributions to his self-managed superannuation fund. Now, with the amount that he had put into the superannuation fund in the 2009 year, he triggered the bring forward rule. So when the contributions went in the 2011 year, there was an excess contributions tax liability. Now, the taxpayer had asked the Commissioner to exercise his discretion and consider the special circumstances and not impose the excess contributions by having some of that contribution allocated to another tax year. The Commissioner declined to exercise that discretion, so it went to the AAT. The AAT looked at the facts and agreed with the Commissioner. The fact that there was a GFC was unusual, but it was not special circumstances. The taxpayer was not surprisingly not particularly happy with that, so the case went to the full federal court. And the full federal court looked at it and saying, well, the AAT interpreted the law too narrowly when it said the GFC and all the relating factors were not special circumstances. So the full federal court has set aside the AAT decision and remitted the case back to the AAT to reconsider it in accordance with the law. Hopefully there will be a better answer for the taxpayer this time around.
And that's the tax roundup for this month. There's a whole world of change out there. If you want to stay on top of things, then talk to Julie on 1800 800 232 about how Knowledge Shop can help you and your team. Speak to you soon.